Thanks for clicking. Canada's economy is in for a bumpy landing, according to a new report by RBC, meaning that Canada is about to head into a recession within the next year, stemming in large part from the Bank of Canada's continual interest rate hikes. The report from RBC comes just as the U.S. core inflation, that is inflation without food and gas prices, came in much higher than expected. This higher than anticipated core inflation on the part of the U.S. is raising expectations that the U.S. Federal Reserve will engage in another supersized rate hike next week. Given that Canada usually follows the United States in the pace of its inflation rate, the acceleration of U.S. core inflation is definitely not a good sign.
You had one job.
So what I want to do today is go over RBC's report, looking at how high they expect interest rates to go for the remainder of 2022, and their predictions for 2023, look over their predictions for Canada's economy going forward, and then discuss what to look for next. Canada's own inflation rate is set to be released next week, which will obviously have a major impact on the pace of our rate hikes for the remainder of the year. We'll obviously have updates out on that inflation rate on this channel. If you want to get those updates, make sure you click like and subscribe. But for now, let's get into RBC's report. RBC's report begins with the premise that although North American inflation may have peaked, it won't ease fully without softer consumer demand, meaning Canadians slowing down the spending. As such, with the need for the central banks to raise interest rates, RBC says that the Bank of Canada will have to cause some short-term pain in order to get inflation under control.
I think you should be grateful.
And we've discussed this on this channel before. The Bank of Canada is unlikely to reverse course on interest rates until inflation is indeed back down to that 2 to 3% target range. And RBC alludes to this in its report. The potential consequences of not acting quickly enough to contain price growth and possibly losing all influence over longer-run consumer and business inflation expectations outweigh the risk of hiking interest rates too much. So the argument is that although these interest rate hikes are going to cause some pain, indeed are causing some pain if we look at the most recent unemployment data, failure to do so would in fact cause more pain for the Canadian economy, for Canadians in general, in the long run. As such, RBC says the Bank of Canada will be raising interest rates up to 4% by the end of the year, or 75 basis points higher than they are right now. RBC then says that in 2023, the interest rate hiking cycle could be over, and we could see a lowering of interest rates when and if the recession hits in 2023. So RBC says that the Bank of Canada will undoubtedly be raising rates even further, which will cause some economic pain, which RBC predicts will result in a 1.7% increase in our unemployment rate. However, RBC says that the good news is that the pain will not be felt by all sectors. While higher interest rates will definitely restrict the purchase of goods, RBC says that higher income households will prop up the travel and hospitality sectors, which should partially limit the damage done to Canada's overall unemployment rate.
How the turntables.
So, in summary, RBC says that the Bank of Canada will be raising rates up to 4% by the end of 2022. This will cause a recession, although the pain should be limited due to higher income households with pent-up savings, spending money in the hospitality and travel and leisure sectors. However, and this is the big however, RBC does admit that interest rates could go even higher than 4% in the new year if inflation persists. And that's a big if. We saw what happened on Tuesday when U.S. core inflation came in higher than expected. Stock prices plunged and yields surged, as traders expect the price of money to get much more expensive in the U.S. And it's not just the U.S. Bond yields in Canada jumped to their highest level in over a month, and we saw our stock market plunge as well, as traders think, quite rightly, that so goes the U.S., so goes Canada. And this flies in the face of what I think a lot of traders are hoping for. They're hoping that the inflation rate comes down, the central banks reverse course as soon as possible, and we go back to a period of 1 and 2% interest rates.
It's going to be beautiful.
But, and we've talked about this on this channel before, as much as many may want to see a return to the 1 and 2% interest rates, while inflation is still up over that 5, 6, 7% range, and core inflation accelerating, core inflation actually getting worse despite the decrease in gas prices. As much as we might like to see those interest rates go back down, the central banks are going to continue to raise rates for the foreseeable future until that inflation rate gets back down under control. If they don't wait until inflation is back down to that target range, at least below 5%, ideally between 2 and 3%, but at least below 5%, then they risk hyperinflation. They risk the complete destruction of our currencies, which they just will not do. The central banks are not going to let our currencies collapse. And as such, I would continue to expect more interest rate hikes coming down the pike. With that said, we will continue to track the updates coming from the Bank of Canada and track our inflation rate and its effects on our economy. If you want to get those updates, make sure you click like and subscribe. But for now, thanks so much for watching.